Imagine an economy where, like, half the country is just buried under $1.26 trillion of credit card debt. They're barely scraping by month to month.
Yeah, it's a grim picture for sure.
Right. But then, in that exact same economy, imagine a single tech company just casually borrowing $35 billion.
Yeah.
And it's just to buy computer chips.
It's just this wild contradiction, really. I mean, you have everyday consumers practically suffocating under these historical debt loads on Main Street, while institutional capital is just, it's practically being set on fire to build out all this infrastructure in the tech sector.
Welcome to another deep dive. Today, we are opening up a massive stack of sources. Specifically, we're looking at the daily market briefing for August 11th, 2026.
That's right.
And our mission for you today is to really just cut through the noise of this incredibly split financial landscape. We're going to decode the signals where this booming AI sector is violently colliding with some really complex macroeconomic realities.
Right, because you've got maxed out consumers on one side.
Exactly. And some very tense global geopolitics on the other.
Yeah, and to really understand why the stock market is behaving with this kind of, split personality today, we have to examine the foundational economic soil first.
Makes sense.
You just cannot understand the tech giants without understanding the environment they are actually trying to grow in.
Okay, let's unpack this. Because starting with that broader economic soil, our sources highlight the upcoming inflation report.
Yes, the CPI.
Right. Expectations are currently pointing toward a modest consumer price index, or CPI, increase for July. And obviously, the Federal Reserve is watching this closely to figure out their next move on interest rates.
Very closely.
But the detail from the Federal Reserve Bank of New York that just completely stopped me in my tracks is this persistent K-shaped economic divide.
Oh, absolutely.
And it's anchored by that staggering $1.26 trillion in U.S. credit card debt.
Yeah, I mean, that $1.26 trillion figure is really the defining bottleneck of the current consumer economy right now. It is. And when the New York Fed talks about a K-shaped divide, they are describing a literal split in economic reality.
Okay, break that down for us.
So the upper arm of the K, that represents individuals who own assets, stocks, real estate.
Right.
And those people are seeing their net worth compound, and they are spending pretty freely. But the lower arm, that represents the half of the population reliant entirely on wages.
Wow.
Yeah, and they are taking on double-digit interest credit card debt just to, absorb the cumulative inflation of the last few years.
Wait, stop there. Because how on earth can the broader market sustain long-term growth if half the consumers are completely tapped out?
Well, that's the big question.
Right, because I picture this K-shaped economy like a bifurcated highway. You've got the asset owners just speeding along in the fast lane.
Exactly.
But then you have this entire other half of the population just stuck in bumper-to-bumper traffic, weighed down by all this debt.
And if we connect this to the bigger picture, that debt burden fundamentally limits consumer spending velocity. And that limitation is precisely the tightrope the Federal Reserve is walking heading into this new CPI report.
So they're trapped.
Pretty much. The Fed has to balance these entirely contradictory consumer realities. Because if they keep interest rates high to sort of cool off that fast lane and make sure the July CPI doesn't spike,
they risk crushing the people on the traffic jam.
Mathematically crushing them, yes.
Yes.
Because the interest on that $1.26 trillion just becomes unmanageable.
Right. But if they lower rates to provide some relief to the indebted consumer, they risk pouring gasoline on the fast lane.
Exactly.
And reigniting the very inflation they spent years fighting.
Which brings us to how the government attempts to intervene when monetary policy is basically trapped.
Okay.
When consumers are strapped like this, we often see tax policy shift to incentivize specific behaviors, like family savings.
Right, which perfectly transitions to a major structural update in the briefing today.
Yeah, the new Treasury guidance.
Exactly. The U.S. Department of the Treasury has issued new guidance regarding tax-advantaged accounts. And I want to be super clear for everyone listening.
Right.
We are looking strictly at the financial mechanics of this new Treasury guidance. We are setting aside the politics of it entirely. We're not taking any sides here. We're just looking at the structural changes outlined in the source.
Purely the mechanics.
Right. So this guidance officially outlines that parents can now make pre-tax contributions directly from their paychecks into a child's Trump account.
Yeah, and structurally, this acts almost like a 401k, but it is specifically designated for a minor's future entrepreneurial or educational expenses.
Okay.
The mechanical shift here is really the payroll deduction part.
How so?
Well, by allowing parents to bypass standard income tax on these contributions directly through their employer's payroll system, the Treasury is attempting to create this automated wealth-building mechanism for the next generation.
Oh, I see. So it creates a frictionless way for families to allocate capital before they even see it in their bank accounts.
Exactly. It reduces their taxable income today while building a nest egg for tomorrow.
Okay, so you have all this tension on the consumer side.
Mhm.
Inflation watches, massive credit card debt, and new tax structures trying to alleviate some of that pressure.
Right.
But then when you look at the corporate side of the briefing, it's a completely different universe.
Oh, totally a different world.
That corporate fast lane is currently paved with AI infrastructure.
Mm.
And I mean, the scale of capital being thrown around is difficult to even comprehend.
Oh, we are seeing historic deployments of capital. I mean, it is far beyond a standard corporate expansion cycle right now.
Let's look at the numbers. Because CoreWeave saw its revenue surge so drastically from the AI boom that their stock popped 12% today,
Huge jump.
making them a top gainer.
Yeah.
But here is the jaw-dropping detail. CoreWeave is sitting on $35 billion in debt.
Yeah, 35 billion.
$35 billion. And at the same time, Intel just upsized their stock offering to $20 billion at $95 per share.
Right.
And that's purely driven by accelerating AI demand and building out data center infrastructure.
Yeah, and that $35 billion debt load for CoreWeave is really the perfect illustration of how the market is functioning right now.
What do you mean?
The market is aggressively rewarding infrastructure growth and future capacity, and it's almost entirely ignoring traditional balance sheet safety metrics.
But taking out $35 billion in debt for computer chips? I mean, that sounds like mortgaging a skyscraper to buy slot machines.
That's a great way to put it.
You're just crossing your fingers and hoping the high rollers actually show up to play? Because if the demand for AI processing slows down even a fraction of a percent, that debt is going to be suffocating.
It would be. But the mechanism behind how they secure that debt is what actually makes it so fascinating.
Okay, how are they doing it?
Well, CoreWeave isn't securing that $35 billion against future revenue promises alone.
Okay.
They are increasingly using the physical NVDA GPUs, like the actual computer chips, as collateral.
Wait, really?
Yeah, the lenders view these high-end AI chips as hard assets. It's almost like real estate to them.
So the chips themselves hold so much intrinsic value that banks are willing to loan billions against them.
Basically, yeah.
Just assuming that even if CoreWeave fails, the banks can just repossess the GPUs and sell them to someone else.
That is the underlying logic right now. In the tech sector's view, AI compute is a winner-take-all race.
Wow.
The calculation is that if you do not build the data centers and secure the physical chips today, you won't even be invited to the table in 5 years.
So it's an existential threat.
Exactly. The market looks at CoreWeave's revenue surge and concludes that demand is so overwhelming that $35 billion in debt is really just the entry fee.
That is wild.
And Intel upsizing to a $20 billion offering at $95 a share. That proved institutional investors are eager to just hand over the cash to fund this specific build-out.
Here's where it gets really interesting, though, because it's not just the hardware builders making moves.
No, it's everyone.
Right. The demand for AI compute is rippling into literally every sector and fundamentally changing how traditional businesses operate.
Absolutely.
Let's look at Meta. They reported strong Q2 growth, which is great,
Very strong.
but it was heavily caveated by these increasingly significant AI expenses. So at what point do these massive, unavoidable AI expenses start eating the very Q2 profits they just celebrated?
Well, that is the multi-billion-dollar question. When everyone is forced to spend billions just to keep up, AI transitions from being a growth engine to a defensive anchor.
A defensive anchor. I like that.
Yeah, because you are spending capital just to maintain your current market position rather than actually expanding it.
And it is bleeding far outside of Silicon Valley, too. Look at retail. Target just appointed its first ever chief AI officer.
Yeah, that was a huge signal.
When a legacy brick-and-mortar retailer, whose biggest historical logistical challenge was, making sure paper towels were stocked in aisle 4,
Right.
when they suddenly create a C-suite position for AI, the underlying supply chain has just become a data war.
Oh, for sure.
Mm-hmm.
And Target isn't hiring a chief AI officer to build a friendly little chatbot.
No.
They are bringing on an executive to manage how they utilize machine learning to predict hyperlocal inventory, to optimize shipping logistics down to the minute.
Wow.
And to reduce warehouse overhead. Compute is literally becoming the core logistical engine of retail.
Which brings us to one of the most wild pivots in today's briefing. Riot Platforms just struck a $9 billion 20-year compute deal with Anthropic.
This is massive.
It is. This signifies a massive shift of Bitcoin miners moving entirely toward AI infrastructure.
And what's fascinating here is to understand why this has happened, you have to look at the mechanics of a Bitcoin mining facility.
Okay, lay it out for us.
These facilities are essentially massive, isolated shells of incredible energy draw and industrial cooling.
But wait, Bitcoin mining uses ASIC chips, right? Like chips that are designed to do literally one math problem over and over again. Whereas AI requires GPUs, which are designed to handle complex, varied tasks. So they can't just flip a switch and run Anthropic's AI models on old Bitcoin hardware.
No, they can't. They have to completely tear out their entire server infrastructure.
That sounds crazy expensive.
It is, but the value isn't in those servers. The value is in the multi-million-dollar industrial cooling systems and the localized energy substations they have already built.
Oh, I see.
Because AI requires massive amounts of power and it generates incredible heat. Riot Platforms already solved the power and cooling problems years ago for Bitcoin.
So they already have the hardest part done.
Exactly. Now they are just gutting the building, swapping the ASICs for GPUs, and partnering with Anthropic to fund the $9 billion hardware transition.
So they are securing a 20-year contract for a resource that the market believes will only become more scarce.
Right.
And speaking of treating compute as a scarce resource, we have to talk about the Chicago Mercantile Exchange. The CME just launched futures contracts for AI computing power.
This completely redefines what compute actually is on a global scale.
But how does a futures contract for computing power even work? I mean, we are used to futures for corn or pork bellies or barrels of oil.
Physical thing.
Yeah. How do you physically deliver a digital concept?
Well, you deliver time and access. An AI compute futures contract likely guarantees a buyer a specific allocation of processing time on a specific cluster of high-end GPUs at a designated future date.
Wow.
Yeah, and by doing this, the CME has officially made AI computing power a tradable asset class. It is no longer just a software service you subscribe to.
It's a commodity.
It has become a foundational global commodity, mathematically modeled and traded just like wheat or natural gas.
That changes the entire paradigm of how companies have to operate. Because when compute becomes a tradable commodity, it means companies aren't just paying a cloud expense.
Right.
Meta isn't just buying servers. They are hoarding a global resource.
Yeah.
It's the equivalent of a shipping company buying an oil refinery just to guarantee they have diesel for their trucks.
Exactly. And when a digital resource transitions into a physical commodity, it suddenly becomes subject to the physical constraints of the real world.
So what does this all mean? Which perfectly shifts how we have to look at the final frontier of our sources today. Geopolitics.
Oh, geopolitics is huge right now.
Because if AI compute is the new oil, it requires physical hardware, immense physical energy, and it exists within physical borders.
Yes.
Now those borders are looking incredibly tense right now.
Yeah.
Let's look at NVIDIA's CEO, Jensen Huang. He has this staggering $500 billion AI financing plan.
$500 billion.
Yeah, but our sources note it is facing severe immediate risks stemming from geopolitical tensions with China.
Because the physical reality always catches up to the digital dream. Jensen Huang's $500 billion plan relies on a highly complex, deeply interconnected global supply chain.
Right.
The physical chips are fabricated in Taiwan using machines built in Europe with materials sourced globally.
If there's any disruption.
If tensions in the South China Sea disrupt the physical shipping lanes or the manufacturing facilities, it does not matter how much demand there is for AI futures on the CME. The physical bottleneck just stops the digital boom.
And the bottlenecks aren't just in the semiconductor supply chain either.
Yeah.
They are in the energy markets required to power these data centers.
Definitely.
The briefing notes that the U.S. oil price just rose above $83 a barrel today. And that is directly tied to a statement from Iran that the Strait of Hormuz will not open until their specific geopolitical conditions are met.
This raises an important question because the Strait of Hormuz is the quintessential geopolitical choke point.
It really is.
When Iran threatens to close it, and oil spikes above $83, the foundational cost of energy for the entire global economy rises instantly.
Right.
Those massive data centers that CoreWeave and Anthropic are building, they require gigawatts of power. If global energy prices spike because of old-school geography and naval blockades, the profit margins on AI compute collapse.
Which feeds right back into the inflation problem we talked about at the very beginning of the deep dive.
Exactly.
The Fed is watching the CPI, but the CPI is reacting to energy costs dictated by naval standoffs in the Middle East. It
Yeah.
really is all connected.
It's a massive web.
And it doesn't stop at the oceans. The briefing points out that the ongoing Ukraine war has sparked a massive global race to build spy satellites. Space tech CEOs are emphasizing that space intelligence is now the critical foundation of modern warfare.
Yeah, the convergence of space tech and AI is perhaps the most critical bottleneck we are looking at today. Space intelligence is no longer a luxury. It is a fundamental requirement for national security.
Right.
But a spy satellite in orbit is essentially just a high-resolution camera.
Just snapping pictures, generating terabytes of raw image data every single minute.
Right, and that data is completely useless if you cannot process it in real time. If you have a satellite tracking troop movements, but a human analyst has to manually review 1,000-gigabyte image files, the intelligence is outdated by the time it reaches a commander.
That makes total sense.
The space tech CEOs are highlighting that the physical high ground of space is intimately tied to data processing on the ground. You need AI to instantly parse those images, identify anomalies, and flag them.
So what does this all mean for us? Can the tech sector truly remain insulated from these global conflicts?
I don't think they can.
Because the way I see it, if you have the best spy satellite network in the world, but you don't have the AI compute commodity to process the images, your multi-billion-dollar space program is basically blind.
Exactly blind.
Nations aren't just fighting over physical territory anymore. They are in an active arms race to control the infrastructure that supports AI compute.
Yeah, they cannot remain insulated. Macroeconomic trends and these incredible technological leaps are ultimately bottlenecked by very traditional geopolitical realities.
Yeah.
We like to imagine tech living safely in the cloud, but the cloud lives in physical data centers, powered by vulnerable energy grids, using chips that must cross contested oceans. The physical world always gets a vote.
It is incredibly sobering when you lay it out mechanically like that. We started this deep dive looking at a stock market that seemed disconnected from reality, rewarding $35 billion in debt while consumers drown in credit card bills.
Right.
But really, the market is just violently reacting to multiple massive structural shifts, all happening simultaneously on a single Tuesday in August 2026.
That's spot on. Synthesizing everything we've covered today, it paints a very clear picture of a world torn between two opposing forces. On one side, you have unprecedented technological investment. Tens of billions of dollars pouring into AI infrastructure, space tech, and Bitcoin miners retrofitting their facilities.
Right, the digital boom.
And this is all driven by the conviction that computing power is the foundational commodity of the next century. But on the other side, you have immense ground-level friction. Yeah, you have a central bank battling inflation, a K-shaped consumer divide struggling under $1.26 trillion in debt, and literal geopolitical choke points threatening the physical supply chains that make all this technology possible.
And that is exactly why, for you listening, tracking this convergence is so critical. Understanding a day like August 11 isn't just about figuring out why a specific tech stock in your portfolio popped 12%.
No, not at all.
It's about understanding the underlying forces shaping the future of the global economy. You have to be able to see the $1.26 trillion consumer debt anchor at the exact same time you see the $20 billion AI infrastructure investments.
Right.
Because eventually those two realities have to reconcile.
The fast lane and the traffic jam are still on the exact same macroeconomic highway.
Well said. As we wrap up today's deep dive, I want to leave you with one final provocative thought to mull over, building purely on the mechanics of that CME futures contract we talked about. If computing power is now officially a tradable, physical, commodity quantified, allocated, and traded globally, just like wheat or water or oil, what happens to global society if we ever face a worldwide drought or a targeted geopolitical embargo of computing power?
That is a scary thought.
Right. We have seen the chaos that ensues when nations cut off the global oil supply. But what happens to supply chains, financial markets, and national security when a nation cuts off the compute that actually runs the modern world?
It would be unprecedented.
Think about that the next time you hear about a localized power grid failure or a supply chain delay. Thank you so much for joining us on this deep dive. We love untangling these complex days with you, and we will catch you on the next one.